Yes, so today I want us to start on this topic. The topic is early adjustment. And when talk about the early adjustment, I think I mentioned about this in our previous session. These are those particular adjustments which are made at the end of the year to some of the items appearing in the trial balance, basically when preparing the financial statement. So if you can be able to recall in our previous topic, we looked on how to prepare the ledger account. And actually, we say that once those particular ledger accounts have been prepared, at the end of the day, they must be balanced. Balances will be extracted, and basically a trial balance must be prepared. So therefore, this early adjustment basically refers to those particular adjustments which should be made to some of the items appearing in the trial balance. Let me give a good example. If you can be able to recall, we said if the company buy an asset or purchases an asset, so that particular asset will be recorded in the ledger account. That account will be balanced, and then the balance will be taken to the trial balance. But basically, what we know is that assets tend to lose some value due to a number of reasons. For example, asset due to passage of time, maybe due to use, due to wear and tear, the asset tend to lose some value. And therefore, a business entity at the end of each year should basically estimate the value the asset have lost at the end of each year. So that particular estimate of that can only be done once the year comes to an end. So therefore, early adjustment basically refers to those adjustments which should be made to some of the items appearing within the trial balance at the end of the year when the financial statements are being prepared. So therefore, these are basically adjustments to some of the items appearing in the trial balance at the year end, basically when preparing a financial statement. So in this topic, you're going to look on various early adjustments. One of the adjustments is adjustment relating to the depreciation. The other one is adjustment relating to prepaid and also the accrued expenses. So number 3, we have the prepaid and also accrued incomes. And number 4, we have adjustment for something called the bad debts, which are written off, and also something called the provision, stroke allowance for doubtful debts, So basically, these are the adjustments which are made at the end of the year when preparing the financial statement. I want us to start with the first one here, and that is the depreciation. So what do we mean by depreciation? Depreciation, basically, this refers to the estimated loss of money value of the asset. It is estimated loss of money value of what? Of the asset. Remember what I've said is that assets such as buildings, assets such as motor vehicles, furniture, and fittings, those particular assets basically tend to lose some value as a result of a number of factors, or basically due to a number of reasons. Like if today you buy a new asset and you keep it somewhere without even using it, due to the passage of time, that asset will lose value. If you buy a car today, 2 million, you park it somewhere, you're not using it. After 1 year or basically 2 years, you can't sell it at 2 million. Due to passage of time, it loses value. Number 2, I've said, whenever you're using some asset, due to wear and tear, those particular assets will do what? Will lose some value. So therefore, basically at the end of the year, a business must estimate the loss of value of what? Of the asset. So therefore, first of all, we can say depreciation. This is the estimated loss of money value. Of assets due to what? So assets will lose value due to what? Number 1 is due to passage of time. Number 2 is due to use. Whenever you're using an asset automatically will lose some value. Number 3 is due to wear and tear. And tear. So asset wear out and also tear. As a result of this, asset will do what? We lose some value. So asset can also lose value due to obsolescence. Obsolescence basically is whereby maybe the asset is no longer needed by the company. Maybe a company had acquired a small machine. That machine cannot be used by the company. So in that case, we may say that that asset is worthless as far as that company is concerned. The asset is no longer needed. So basically that asset is is worthless. So therefore, these are basically some of the reasons why the asset lose some value. And therefore, at the end of each year, the business should actually estimate the loss of money value of the asset, and that loss of money value of the asset should then be recognized as an expense, or actually should be treated as an expense when the business is computing the profit or loss. Because generally what we know is that the asset lose value because they are being used. So they are being used in the business in generating income. So therefore, that loss of money value of the asset, we are saying that this one will actually be accounted for as an expense when computing the profit or loss for the year. Whenever the business is computing the profit or loss, then this one should be treated as what? As an expense. Now here we have various methods which can be used by a business entity to estimate loss of money value of what? Of assets. So if you want to estimate the value an asset has lost at the end of the year, there are various methods you can be able to use as an accountant. So let's look on those methods. We look on the methods of estimating depreciation, methods of estimating, or in other terms, we can talk of methods of computing depreciation. Methods of computing what? Depreciation. Methods of computing depreciation. Now here we have various methods. The first one is called the straight line method. The straight line method. Number two, we have the reducing. The reducing, also known as the diminishing balance method. Balance method. Number three, we have something called the sum of years digit method. Sum of years digit method. Sum of years digit method. Basically, these are the various, actually we can say these are like the common methods, though we also have other methods which are not that common. In fact, most of the companies uses the first two, the first two methods, but we also have other methods like number four, we have something called the revaluation method. The revaluation method. So we also have this one, that is the sum of years digit method. Do we have any other method? Yes. So we also have another method, though basically I'm saying some of these methods are not that common, So we also have something called the machine hours method. The machine hours method. And final number six, we have, yes, I think basically we can talk of those method, depreciation units. Yes, let's just talk of those methods, because I've said, in fact, you'll be able to see that once we start doing some questions from the past papers, usually you'll be told a company depreciates the asset using either straight line or basically the reducing balance method. So the two main methods of estimating depreciation are the first two. Now, how do we apply or how do we estimate depreciation or the loss of value of assets using these particular methods here? So let's start with the first one, which is the straight line. The straight line method. Straight line method. Now, under this particular method here, we compute the depreciation based on the cost of the asset. So in other terms, under this particular method here, an asset is assumed to lose value uniformly throughout its useful price. If, for example, you buy an asset and maybe you estimate that you're going to use that asset maybe for the next 10 years, Under this method, we assume that this asset loses value uniformly. So if it is losing value uniformly, it basically means that depreciation for different years will be the same. Depreciation for year 1, depreciation for year 2, depreciation for year 3 up to year 10 will be the same. Will be the same. So under this particular method here, assets are assumed to lose value uniformly. To lose value what? Uniformly throughout their useful life. And therefore, in this case, to compute the depreciation per annum, so in this case, the depreciation per annum here, we are referring to the depreciation for each year. So the depreciation for each year, this one is computed by taking the cost of the asset minus the residual value. The residual value is also known as the scrap value. Is also known as the scrap value. The scrap value. We divide this with what? We divide this with the estimated useful life. Estimated useful life of the asset. Estimated useful life of the asset. So that's basically how we compute the depreciation per annum. The cost of the asset minus the residue or the scrap value. So in this case, what do you mean by the scrap or the residue value? The residue or the scrap value, this basically refers to the value of an asset or to the estimated value of an asset at the end of its useful life. Basically, what that means is that you can buy something like a motor vehicle to be used in your business, and you expect to use this motor vehicle for the next 10 years. Automatically, at the end of the 10th year, you will sell it at a small amount. So that value at which the asset is expected to have at the end of its useful life, or the value at which an asset can be sold at the end of the useful life. The useful life basically the number of years the asset is to be used. If you're using an asset, you expect to use an asset for the next 10 years, basically you're going to sell it at an amount of how much at the end of the 10th year. So that is what we refer as the residue or the scrap value, the estimated. This is the estimated value of an asset at the end of its useful what? Useful life. At the end of its useful life. That value of an asset at the end of its useful what? Life. We refer to that as the residue or scrap value. So therefore, we take the cost of the asset minus the residue or the scrap value. We divide that with the estimated useful life of the asset. Alternatively, we can also compute the depreciation per annum here. The depreciation per annum here, the depreciation per annum by taking the cost of the asset, and then in that case, we multiply with the rate of depreciation with a rate of what? Depreciation. For example, in this case, you can be told that the company is depreciating assets at the rate of 20% per annum, 20% per annum. So mean that you're given a rate here. So when computing the depreciation under this particular method here, you multiply that with the cost. You multiply that with what? With the cost. So the cost basically is the amount at which the asset was acquired. So the asset was bought at an amount of how much? So therefore, this basically how we compute the depreciation per annum of an asset using which method? Using the straight line method. Using the straight line method. Maybe what is important for you to note here is that under this method, that is under the straight line method, the depreciation per annum, this one is computed based on cost. Depreciation per annum is computed based on cost of the asset, based on the cost of the asset. Because once we start doing some or preparing financial statements of companies, you'll be given a trial balance. Maybe you're given a number of assets, and then you're given some information. You're told, for example, an asset like motor vehicle will be depreciated at the rate of 20% per annum using straight line method. So if the company is using straight line method, when computing depreciation per annum, which then you recognize or you treat as an expense in the income statement, you take that rate which you're given, you multiply that with the cost. You multiply that with the cost. You multiply that with the cost. But if, for example, you're given now this information, the cost, the residual value, the estimated useful price, then this is the formula you need to remember. This is the formula you need to do what? To remember. So the cost minus the scrap or the residual value divided that with the estimated what? Useful price of the asset. Estimated useful price of the asset. Estimated useful price of the asset. I don't know whether there is a small illustration which I've included within my notes there. Within my notes there. Yes, so we have a small illustration. Maybe you can just go to the notes, to the handout which I've shared with you on this topic. There's a small illustration. We can check that small illustration. Are you there? The small illustration in the handout. Small illustration. Small illustration. Are you there? Are you there? You need to confirm whether you can see that. Basically, that is in page number. I think in the handout it should be in page number 3. Page number 3. Page number 3. Page number 3. I don't know whether you are there. If yes, just confirm. Yes, are you there? Okay. So in that small illustration, what are we told? We are told that this company, which is called XYZ, bought a furniture worth 200,000. Bought a furniture worth 200,000. And then in this case, we are told that the furniture was expected to last 8 years and would be disposed of for shillings 40,000 at the end of a year. So in that case, we are required to calculate the depreciation to be allocated to each of the accounting period for each year, for 8 years, using the straight line method of depreciation. So in that case, we are given information about a furniture. Basically, a furniture we know is an asset which was bought by this company, and you are told that that particular furniture had a cost of 200,000. That is the cost. Maybe you can have the solution here. The solution here. Yes, so in this case, we are told the cost of that furniture is what? Is 200,000. And then we are also told that the expected useful price, expected useful life, in this case are 8 years. 8 years. And then you're told it can be disposed of at the end of a year for 40,000. So this particular amount here, 40,000, what is this? Who can tell us the name for that? That amount at which it can be sold at the end of the year. So this amount we refer to it as what? The name given to this amount here. Yes, so this is what you have referred to the scrap, or basically the residual value. The scrap or the residual value in this case is an amount of 40,000. Is an amount of 40,000. So what you're required to do here is we compute the depreciation per annum of this particular asset using straight line method. So meaning that the depreciation per annum, we need to record the formula will be equal to the cost minus the scrap, or basically the residual value. The residual value, we divide that with the estimated useful life, estimated useful price, estimated useful life. So in this case, the cost is the 200,000. The scrap value is 40,000. 40,000, and then we divide that with the estimated useful price, 8 years. So, and this will give us 160 divided by 8, which will give us shillings 20,000 per what? Per annum. Shillings 20,000 per annum. Per what? Per annum. So, meaning that the amount which the company will recognize, the amount the company will recognize in the income statement as an expense, then this one will be, or basically will be an amount of how much? 20,000. 20 what? 1,000. Yes. 20,000. That's basically how we compute the depreciation per annum using which method? Straight line. But in this case, I've said, if, for example, you're given the rate, in most of the cases, the examiner will just give you this. He will give you the cost. He will not be given the estimated useful life and the scrap value. So if you're given, for example, the rate of depreciation, you're told the rate of depreciation is something like 20%. So in this case, when computing the depreciation per annum, you take the rate and then you multiply that with the cost. That is in year 1, year 2, year 3, year 4, up to year 8. The depreciation will be the same. That's what you have said under this method. This method assumes that the asset lose value uniformly throughout its useful life. The depreciation will not change. It remains the same. So if we are together up to that point, I want us to move to the other method, number 2. Are we together up to that point? Can we move to method number 2? Can we move to method number 2? Yes, let's move to method number 2. We move to method number 2. And method number 2 is what? Number 2 is the reducing, also known as the diminishing balance method. Diminishing balance method. Diminishing balance method. Now, under this particular method here, the diminishing, or basically the reducing balance method, it is assumed that the asset loses more value in the first years of use, because generally, if you buy a new asset, that asset is said to be used more because it's new. So as it gets older, the use of that asset keep on reducing. So in terms of how you're using the asset, basically the use keep on reducing. So under this method, we assume the asset had to lose more values in the first years of use. As it gets older, because it's not used, or basically its use keep on reducing, its depreciation also keep on reducing. So therefore, under this method, you'll be able to see depreciation keep on reducing. So therefore, under this particular method here, depreciation per annum is computed using the net book value, So the net book value, this one is also known as the carrying amount, So how do we determine the net book value, or how do we determine the carrying amount? So the net book value of an asset, which is also known as the carrying amount, this one is equal to the cost minus accumulated depreciation, minus the accumulated depreciation. So therefore, under this method here, we compute the depreciation of assets based on something called the net book value. So net book value is equal to the cost minus accumulated depreciation. So therefore, how do we compute the depreciation of an asset per annum? The depreciation of an asset per annum is equal to the rate of depreciation, the rate, maybe we can denote this with R, times the net book value. So this one, we can denote it as the NBV, net book value, net book value. So in this case, you take the rate, you compute what? The net book value. I'll be able to show you how we compute the net book value. So or basically how you'll be able to understand how we do this in an illustration. And I think with that knowledge, there is also a small illustration in that handout, which I've shared with you. And that is basically what I want us we attempt. So can you go to the same page when where we had the other illustration? The other illustration, we have an illustration there. I hope you can see it, which reads, an equipment was bought. Can you see that? We are told an equipment was bought for shillings 300,000. I hope you can see that. Small illustrations here. An equipment was bought. Yes. Okay. An equipment was bought for shillings 300,000, and depreciation is to be charged at the rate of 25% on reducing balance method. So what are we required to do? We're required to show the calculation of the depreciation charge for the first 3 years of use. So we are required to compute the depreciation of this asset for the first 3 years of use. The first 3 years of use. Remember, in this case, we are told that the cost of this asset, is 300,000. And then in this case, we are told the depreciation per annum, not the depreciation per annum, but basically the rate of depreciation in this case is 25%. So how do we compute the depreciation per annum? So, and remember, you're required to compute depreciation for year 1, depreciation for year 2, depreciation for year 3. So in year 1, for us to compute the depreciation, we must recall this formula here. Depreciation per annum is equal to the rate times the net book value. Times the net book value. You must also remember how we compute the net book value. So therefore, in year 1, the depreciation per annum will be equal to the rate, which is 25%, times the net book value. What is the net book value? It is equal to the cost minus accumulated depreciation. The cost is this one, 300,000. What about the accumulated depreciation? Now remember, in year 1, this asset is new. This asset is new. It was bought at the start of year 1. So it basically means that this asset has not lost any value, because accumulated depreciation is the total value the asset has lost. This is a new asset. So meaning that the accumulated depreciation in year 1 is always 0. The accumulated depreciation in year 1 is always what? 0, because this is a new asset. Is a new asset. That is how we compute the net book value. So therefore, we take 25% of this. 25% of 300,000. How much is that? Is it 75,000? 75,000? Yes. 75,000, is that what you're getting? 75,000, is that what you're getting? Is that what you're getting? 75,000. $75,000. Is that what you're getting, Akina Peter Purity? Please confirm. Yes, 75,000, 75,000. Okay, so then we move to year 2. Year 2. So in year 2, the depreciation per annum, we don't need to repeat the formula. We will take the rate, 25%, times the net book value. The net book value will be equal to the cost. The cost is 300,000. And then in this case, who can tell us what is the accumulated depreciation? In year 2, our asset has lost a total depreciation of how much? In year 2, our asset has lost a value of how much? Remember, our asset has just been used for 1 year. At the end of year 2, or basically in this year, the asset was only used in year 1. So meaning that the accumulated depreciation here will be equal to 75,000. So this particular amount here, that depreciation, that value the asset lost in year 1. So we get the difference. Whatever you get here, this is the net book value. Then you multiply that with 25%. Get 25% of that. That will give us what? That will give us what? What are you getting? I'm told by Evans. That will give us 56,250. 56,250, is that what you're getting? 56,250. 56,250. Is that what you're getting? 56,250. Yes. So then let's move to year 3. Year 3. Year 3. So in year 3, the depreciation per annum, or the depreciation for this year, will be equal to the rate 25% times the net book value. The net book value will be equal to what? It will be equal to the cost, which is 300,000. 300,000 minus the accumulated depreciation. Now, who can tell us what will be the accumulated depreciation here in year 3? The accumulated depreciation in year 3. 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 I'm told 131,250. That is a figure I'm getting from RIN. The rest getting the same. Purity. Peter, what are you getting here? What are you getting? What are you getting? I want to know what is the accumulated depreciation. Yes, the accumulated depreciation now here will be this one. Our asset lost a value of 75,000 in year 1. In year 1, our asset lost a value of 56,250 in year 2. The accumulated depreciation, therefore, will be this plus that. And that will give us 131,250. So we get the net book value, and then we get 25% of that. We get 25% of that. 25% of that. Yes, what are you getting here? What are you getting? What are you getting? You're getting what? You're getting what? 300 minus 131 to 50 times 25% times 25%. What are you getting? What are you getting here? 42,187. 42,187. Point what? 0.5. Sasa? Yes. So that's how we compute the depreciation under the reducing or the diminishing balance method. And remember, in this case, I've said these are the two common methods most of the companies use, either the straight line method or the reducing balance method. So what you need to recall is that under the straight line method, depreciation is computed on cost. Under the reducing balance or the diminishing balance method, the depreciation is computed based on the net book value, based on the net book what? Value. So are we allowed to round off? No, if you get a figure like that, 42,187, no need of rounding off that figure, unless now you get a figure with so many decimals, like more than 3 decimal places. So that is a figure you need to round off. Sasa? Yes, yes. So, but such a figure, you don't need to round it off. And because it's just 42,187. Sasa? Yes. So therefore, maybe to conclude on this method, we can say that under reducing balance method, under the reducing balance method, depreciation is computed based on net book value, based on the net book value, is computed based on the net book value. That's basically what you need to remember there. Yes, so then from there we can proceed and look on the other method. The other method, which is the number 3, and that is sum of years digit method. Sum of years digit method. Now, under this particular method here, or this method has the same assumption, just like the reducing balance method. This particular method assumes that asset tend to lose more value whenever an asset is used, but as the asset gets older, it loses less value. It loses less what? Value, because it is becoming less efficient as it gets what? Older. So how do we compute the depreciation under this method? We compute the depreciation under this method based on something called the sum of years digits. We compute the depreciation based here, or based on something called the sum of years digits. So what do you mean by sum of years digits? Like in this case, we assume that you're told a company acquired an asset, and that asset is expected to have a useful life of 5 years. That is the useful life of the asset. So what we do, first of all, we come with the years digit. The years digit, basically, this asset will be used for year 1, year 2, year 3, year 4, year 5. These are known as years digit. Years digit. So get their sum. Get their sum. So their sum will be this plus this, or we add all this. This will be 3, 6, 10, 15. So that is the sum of years digit. Alternatively, to get the sum of years digit, there is a formula which we use, Sn for the sum of years digit, which is equal to n multiplied by n plus 1 divided by 2. So n is the useful life. If the useful life of the asset is 5, your n is 5. So to get the sum of years digit, we take 5, or we take n, which is 5, multiplied by n plus 1, divided that with 2. So this will give us 6. That is 5 plus 1 is 6, times 5, which is 30. 30 divided by 2, which will give us what? 15. So you can either add all those or use that formula. They should give you the you should get the same answer, the same answer. Now, after getting the sum of years digit, assuming in this case we are told that this asset, the asset maybe we are depreciating, for example, has a cost of something like 450,000. 450,000. So how do we compute the depreciation of year 1? The depreciation for year 1. So what we do, we take the last digit, which is basically 5. We divide that with the sum of years digit, which is 15, times what? Times the cost, which is 450. 450. So, but there are some instances whereby you may be told that that asset has a scrap value. So if you're given the scrap value of an asset, you less it here. If you're given the scrap value, you less it what? Here. But if you're not given the scrap value, then that is the formula which you use. Understand? Yes. So in case you're given a scrap value, you always less it here. So assuming in our case is 0. So then how do we compute depreciation for year 2? Depreciation for year 2, we take the second digit from last, which is 4. 4 divided by 15 times what? Times 450,000 minus what? Minus 0, which is the scalar value. Then depreciation for year 3, we take the third digit from last, which is 3 all over 15 times 450 minus the scalar value. The depreciation for year 4, we take this digit 2 all over 15 times 450 divided, minus the scalar value. And then final depreciation for year 5, we take now this one, which is 1 all over 15 times what? Times the cost minus the scalar value. And then we get what? The depreciation. So that's basically how we compute the depreciation of the asset. The depreciation of the asset using what? Using the reducing, not the reducing, sorry, using the sum of years digit method. The sum of years digit method. The sum of years digit method. And I think if you check on the handout, also there is a small illustration there regarding how to compute the depreciation per annum using the sum of years digit method. Then from there we have the other method, which I've said is not very common, and that is the machine hours method. So when we talk about the machine hours method, this is basically a method which is used in estimating the loss of value of a machine, which is basically expected to be used for a number of years in its useful life. If, for example, you buy a machine and maybe you expect that you're going to use this machine maybe for like 1,000 hours, maybe 500 hours, you can be able to estimate the number of hours the machine will be used. So in that case, you can compute the depreciation using what? Using the number of hours the machine has been used in a certain financial year, meaning that to compute the depreciation per annum, under this method, we take the machine, the number of machines, or sorry, that is the number of hours, used. So in this case, the number of hours used basically referring the machine was used for how many hours in that financial year, and then divide that with expected hours of use, times the cost, If, for example, the cost of the machine is something like 450, maybe in a certain financial year, the machine was used maybe for like 10,000 hours, but the machine is expected to be used maybe for 100,000 hours, So the machine during the current year was used for 10,000 hours. So check the number of hours the machine was used, all over expected hours of use times the cost. That will give us the depreciation per annum. Though I've said some of these methods like this one are not common, but it's important for you to understand how do we compute the depreciation of the asset under this particular method cell. Yes. So, and I think in our case we are done with those particular various methods of estimating the depreciation. Then from there we can finally look on the accounting treatment of depreciation. How do we treat the depreciation? How do we account for depreciation? Now, depreciation basically, this one is accounted for. Depreciation per annum is a revenue expense in the business. When we talk about the revenue expenses, these are those particular expenses which are incurred as a result of the normal operation of the business. So in these particular expenses, we always deduct them from the total incomes of the company in computing the profit or loss. If you want to know the profit or loss of a company, you take the incomes generated by that company, generated by that entity, you less revenue expenses. So Maybe we can say that revenue expenses are what? Are expenses related to the trading activities of the business, relating to trading activities of the business, and they are used in computation. They are used in computation of a profit or loss. They are used in the computation of a profit or loss for the year. They are used in the computation of profit or loss for the year. They are used in the computation of profit or loss for the year. Those particular expenses which are related to the trading activities of the business, these particular expenses, we use them in the computation of the profit or loss for the year. It basically means that for you to compute the profit or loss of a business, for you to compute the profit or loss of a business, you take the incomes minus the revenue expenses. So the revenue expense, one of the expenses you should deduct from the total incomes is what? Is the depreciation. Is the depreciation. Now, how do we account for this depreciation, or basically what is the accounting entry? So in this case, when we talk about the accounting entries, we are referring to the double entry. What is the double entry of the depreciation? What is the double entry of the depreciation being an expense? Accounting entries. Accounting entries, which we are saying is the double entry. So in this case, we debit something called the depreciation. Or in this case, let me just put it like this. We debit the income statement. We debit the income statement. So income statement, this one is debited with all expenses. All expenses are debited in the income statement, and your state depreciation is one of the expense. Debit income statement, you treat that as an expense in the income statement, and then we credit an account called a provision for depreciation. Provision for depreciation account. Provision for depreciation account. Provision for depreciation account. That is a double entry. Any depreciation for the current year, we basically do what? We account for that as an expense in the income statement, and then we credit the provision for depreciation account. Provision for depreciation what? Account. So that basically is the double entry for this particular depreciation. Yes. Yes, someone is asking about the accumulated depreciation. Yes, RIN, that is the same, though the current name which we use is this one. Though I think this one is also known as, the provision for depreciation can also be known as accumulated depreciation account. So the provision for depreciation account can also be known as accumulated depreciation account. So by the end of the day, this account, the balancing figure in that account will be the total depreciation of the asset. Will be the total depreciation of what? Of the asset. So that is it. That's basically how we deal with the what? We compute the depreciation, we estimate the depreciation, and then from there we account for it. Now, I want us to take a short break, and then once we come back, I want us to continue with our discussion by looking on discussing what are prepaid and basically what are accrued, prepaid and accrued expenses. So this is what I want us to discuss once we come back after the short break. So let's just take a short break of 10 minutes. And then once we come back, we discuss on this. Yes, I want us to continue with our discussion on this early adjustment. And I want us to start by looking on what are the prepaid and also accrued expenses. Now, we start with the accrued expenses. Let's start with the accrued expenses. Accrued expenses. Now, these are those expenses which are incurred by a business, but when the year is coming to an end, they have not been paid. You have a business, you have incurred some expenses, but you have not paid for them. A good example is whereby when the year is coming to an end, maybe there is an electricity bill or maybe a water bill which you have not paid. Now, these expenses which have already been incurred, not yet paid, in other terms, we refer to them as outstanding expenses. Outstanding expenses, or expenses due, or expenses due, or expenses due. Now, how do we treat these particular expenses, specifically when preparing the financial statements? Number one, these expenses which have already been incurred but not yet paid, it is important, first of all, you note that they will not have been accounted for. When balancing your ledger accounts, because you have not paid for these particular expenses, because you have not paid for these expenses, you will not have accounted for them, meaning that they will not have been recorded in the respective ledger account. So meaning that these particular expenses, when preparing the financial statement, number one, you should add them, or we can say they are added to expenses already paid. They are added to the expenses paid, and the expenses paid, these are expenses appearing in the trial balance. These are expenses appearing in the trial balance. Add them together. The expenses in the trial balance, which are expenses which have already been paid, and those particular expenses which have not been paid, they are not part of the expenses in the trial balance. Number two, these particular expenses, we treat them as current liabilities. We treat them as current liabilities. So when we talk about the current liabilities, a liability we know is a financial obligation, is what the company is supposed to pay. Now, current liabilities, basically, these are liabilities payable by the company within 1 year. These are liabilities payable within 1 year. If you have not paid for your electricity bill, you have not paid for your water bill, automatically you must pay that within maybe the next 1 month. You must clear that electricity or water bill. So this is how we treat the accrued expenses at the end of the year. You add them to the expenses already paid, and we are saying these are expenses in the trial balance. Number two, when preparing the statement of financial position, and actually we're going to look on how we prepare this, you treat them as current liabilities. Now, on the other hand, what are prepaid expenses? What are prepaid expenses? Prepaid expenses, in other terms, we can refer to them as expenses paid in advance. Expenses paid in advance. Expenses paid in advance. And this refers to those particular expenses which have been paid before they are incurred. You have paid for a certain expense before incurring that expense. A good example is whereby you have a business, but you decide to pay the rent for the next 3 months in advance. You pay, maybe when paying the rent for January, you pay the rent for January, for February, and for March. So therefore, in this case, we say in January, the rent for Feb and also the rent for March have been paid in advance. So these are expenses which have been paid in advance. Expenses paid in advance. Expenses paid in what? In advance. How do we treat these particular expenses paid in advance? Number one, these expenses are always deducted from expenses already paid. From expenses already paid. They are deducted from the expenses already paid. And that is when preparing the income statement. When computing the profit or loss for the current year, you deduct them from the expenses already paid. I'll be able to explain the reason behind this and this. I'll be able to explain, but let me first of all, explain how we treat this, deduct them from the expenses already paid. And number two, when preparing the statement of financial position on the balance sheet, these ones are treated as current assets. So if you have paid an expense in advance, remember this money you can demand to be refunded. This money you can demand to be refunded. So this is an asset to you, is a current asset. Now, why do these particular expenses which have not been paid, why do we add them to the expenses already paid? These expenses which have been paid in advance, why do we deduct them to the expenses already paid when computing the profit or loss for the year? Now, the reason why we do this is because when preparing the income statement, or basically when computing the profit or loss for the year, there is a certain principle which is used, or in other terms, we refer to it as an accounting concept, which is known as the accrual concept or matching concept. So when computing the profit or loss, or basically when preparing the income statement, we use this concept known as the matching or accrual concept. So accrual concept or the matching concept is like a principle, or is an accounting principle, or is like an accounting rule that whenever you're computing the profit or loss for the year, what you do, you take the incomes of that year, minus expenses for that year. And in this case, when taking into account the expenses for the year, you take those particular expenses which relate to that year, whether they have been paid or not. We don't take into account the expenses which have been paid. You take into account expenses for that year. For example, assuming you pay in your business, you pay a rent of 20,000 per annum. Sorry, not per annum, but rather per month. It basically means that when the year is coming to an end, your rent expense for that year will be what? Will be 20,000 per month times what? Times 12. That will give us 240. But let's assume that when the year is coming to an end, then you have not paid rent for 1 month. You have not paid rent for 1 month. So meaning the rent you have paid and you have already accounted for that will be the rent for 11 months. Now, the question arises here. Whenever you're computing the profit or loss for that year, do you use 240,000? Do you use 220? So in this case, I've said according to this concept, accrual or matching concept, you use the expenses for that year. You use the expenses for what? For that year, whether they have been paid or not. So like in this case, we can say out of this rent of 220, there is a rent which has not been paid for 1 month. So that rent which has not been paid for 1 month is now what you refer as the accrued expense. So when computing the profit or loss for that year, you will take what you have paid to 20, then you add the accrued rent, which will be the rent for 20,000. So such that when computing the profit or loss, you are going to use the rent for that year, not what you have paid, but the rent for that year. Sasa? Yes. So that's why any expense which has not been paid, it has to be added to the expenses already paid based on this concept, the accrual concept. Number two, let's assume that when the year is coming to an end, maybe your rent for the whole year is 220, but when the year is coming to an end, for example, you have prepaid your rent, and maybe you have paid a rent of 280. It basically means that because the rent for the whole year is 240, then a rent of 40,000, this one is prepaid. You have paid this rent in advance. So now, when computing the profit or loss for that year, do you use 280? No, because part of the rent you have already paid of 40,000 does not belong to the current year. So when computing the profit for that year, you only use the rent for that year, which is 240. Don't use that amount which relates to the following financial year of 40. So that's why we are saying this rent which you have paid in advance, you deduct it from the expenses already paid. Number two, whenever you are preparing your balance sheet or your statement of financial position, this rent which you have paid in advance is an asset to you. You can approach the landlord and you request to be refunded that rent of 40,000. It's basically a current asset. It's a current what? Asset. Sasa? Yes. So that's basically how we deal with or how we treat the prepaid and also accrued expenses. So the other idea adjustments, and that I hope that has been you have understood what Mwalimu explained here. Watu wameelewa venye Mwalimu amesema hapo about prepaid and also accrued expenses. Is that understood? Yes or no? Purity? Peter? Paul, is that understood? Yes. Okay. So next, let's proceed and move on something called the prepaid. Prepaid and the accrued incomes. The accrued incomes, prepaid and accrued incomes. So I will start with the prepaid incomes. Prepaid incomes. So prepaid incomes, basically, these are the incomes. Remember, an income is money you receive from your customers, is money you receive from your customers as a result of the services you provide to them, or as a result of the goods you sell to them. So a prepaid income is basically an income you have received from your customer in advance before you provide the necessary services, before you supply the necessary goods. So this is money your customer can come back and refer to and claim to be refunded. You have not supplied the goods, you have not done what? You have not basically provided the agreed services. So this income which you have already received in advance, number one, you treat this as a current liability. This is money you have received, but it belongs to your customer because you have not provided the agreed services. You have not provided what? You have not provided the agreed services. You have not supplied the goods as agreed. So that is a liability to your business. Your customer can demand to be refunded that amount of money. Number two, this one is also deducted from the incomes for that year, deducted from the incomes for that year. A good example is whereby you can be told that the sales made by the business was 500,000. These are the sales of the business, but you're told that these sales include a customer's deposit of maybe something like 50,000. So a customer deposit is basically money which a customer has paid in advance before you provide the services, before you supply the goods. So these customers' deposit, number one, you're saying when preparing the statement of financial position is a current liability, and number two, when computing the profit or loss for that year, you have to deduct that from your total sales. That amount has not been earned. So you earn an income from your customer by providing services or by supplying their goods, by providing the services, or basically by supplying the goods which have been agreed. So you have not done that. So you have not earned that income. So that's why we are saying you treat it as a current liability. And number two, you also deduct it from what? You also deduct it from the incomes generated. Then from there we have accrued incomes. Accrued incomes, basically, these are the incomes which have not been received, which have not been received, incomes which have not been received. So in this case, you have already provided services to your customer, you have already supplied goods to your customers, but your customer has not paid you. So to your business, that is an accrued income. So this accrued income, number one, to your business is a current asset. To your business is a current what? Is a current asset. Is a current asset. You expect to receive this money from your customer maybe in the near future. Number two, this one is also supposed to be added to the incomes already received. 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 Sasa, that's how we deal with the accrued incomes. So we are done with that. I want us to move to the other area adjustments, and that is something called the bad debt written off. Bad debt written off. Bad debt written off. Now, what do you mean by bad debt written off? Bad debt written off, basically, these are those particular debts which are irrecoverable. These are irrecoverable debts. Irrecoverable debts. Irrecoverable debt. So when we talk about the recoverable debt, this basically refers to the amount of money or basically the amount you are demanding from your customers, but your customers have totally declined to pay you. They have totally declined to pay you. So you cannot recover this particular amount of money from your customers. Now, do you continue retaining that particular amount in your books of account as an asset? Your customers owe you an amount of 40,000. You have tried to make a follow-up. Calling your customers and maybe sending some demand letters, but they are not paying. So basically, because you're in business, you need to give up and say that the customers, by the end of the day, will not pay this particular amount. So therefore, once the debts have become irrecoverable, then what do you need to do? You need to write it off. And actually, once your customers have failed to pay you, this is a loss to your business. So being a loss, these particular bad debts which have been written off, this one are treated as an expense. Whenever you're computing the profit or loss, you basically account for this accumulated depreciation. This accumulated depreciation, you account for it. Sorry, not accumulated, sorry, depreciation, sorry. This bad debt written off, you basically account for this as what? You account for this as an expense. So, and maybe you can look on some of the reasons why some debts will be written off. Some of the debts will be written off. Why do you decide as the owner of the business that I need to write off this particular amount? One reason is because the customer, or basically the debtor has been declared bankrupt. Maybe there is a customer who owed you an amount of 100,000. So by the end of the day, that customer has been declared bankrupt, has been declared insolvent. There is no way you're going to recover that particular amount of money from that customer. So the other one, number two, is closure of business. Closure of what? Of business. Closure of business by a customer. So a customer who owed you money has closed his business. So if he has closed his business, do you continue following that person and he closed his business? Automatically, he will not pay you because he has closed his what? He has closed his business. So as a result of that, you have now to make a decision that you have to write off that amount. You have to write off that particular what? Amount. And the other one is failure by the customer. Failure by a customer to pay a particular invoice. So you sent a number of invoices to your customers, but the customer has totally declined to pay a certain invoice, maybe due to certain reasons. So if that is the case, you have to write off the amount which was demanded using that particular invoice. And maybe the other one is after, or maybe that is the other one, number 4, is maybe unfulfilled promises. Unfulfilled promises. In other terms, we can also refer to this as dishonesty by a customer. So a customer owe you a certain amount of money, say 20,000, but the customer keep on promising that he will pay, but he's not honoring that promise. So by the end of the day, you have now to decide to write off that amount. So once you make that decision, you need to go ahead, write off that debt. So now, how do we account for this? So what is the double entry? What is the double entry for the bad debt written off? So the bad debt written off, this one will be debited in the account called the bad debt. The bad debt, remember in this case, you have said that the bad debt can also be known as the irrecoverable debt. So you may come across a question whereby the examiner has not used the word bad debt, but he has used the word what? Irrecoverable debt. Irrecoverable debt account. So we debit that account and then we credit the trade receivables. So what do we record in the trade receivables account? The trade receivables account, this is the same with the debtors. So the trade receivables is the amount of money you're expecting from your customers because you sold some goods to them on credit, or because maybe you provided some services to them on credit. Remember, the amount of money you are expecting from your customers, this is an asset. And because part of it has been written off, you have to write it off. And because it's an asset, we say that once an asset reduces, what do? Once an asset reduces, we do what? We credit. That's why you can see we are crediting the trade receivables. You expected maybe 250,000 from your customers, and you have written off an amount equal to 50,000. So the amount of money you're expecting from your customers has reduced by 50,000. So you have to do what? You have to credit that account. You have to credit that account. Yes. So I can see Evans there is saying one of the reasons why you have to write off the debts is maybe due to the customer's death. You can do that, though in most of the cases, basically what you need to know is that if a person dies, it does not mean that the debt of that person will not be paid because that person left behind some assets. So basically what happened is that the assets he left behind are the ones to be used in paying his debts. That's that? Yes. And the asset to be used in paying his debt. So therefore, it's not an obvious reason that once a debtor dies, we have to write off his what? His debt. Because if he left a business which was running, if he left some asset, those assets are the ones which are used in terms of clearing his what? Clearing his debts. So that's basically how we account for that. How we account for that. And all this what we are discussing, I hope you can see there is no much illustrations we are doing in all our discussion here. These are the topics, or you need to have this particular knowledge in the other topics which you are going to cover. Because now from here, we are moving to other topics regarding preparation of financial statements. We are going to look on how we prepare financial statements of a sole trader, financial statements of a company, financial statements of who? Of a partnership, financial statements of manufacturing entities. You need these knowledge. Sasa, yes, because you'll be given a trial balance, just like the one which we prepared, and then you're also given additional information. You're told maybe one, the company is depreciating motor vehicle at the rate of 15% per annum on straight line. Number two, you're told maybe expenses or salaries and wages amounting to 50,000 were accrued at the end of the year. You must be able to know how do we account for those accrued what? Expenses. You may also be told that a certain expense was prepaid. How do we account for that? So this knowledge or this particular concept we are discussing here is very, very important, specifically on those particular topics for preparing the financial statement. That's why you can see we don't have so many illustrations here, but this particular knowledge, we are going to use it in the topics which we are going to cover after this. Yes, so then from here, I want us to discuss the last concept, and that is what? The doubtful debts. Doubtful debts. Doubtful debts. Doubtful debts and a provision or basically allowance for doubtful debts. Allowance or provision for doubtful debts. So first of all, what do you mean by the doubtful debts? Doubtful debts, basically, these are not the same with the bad debts written off, but doubtful debts, these are those particular debts the owner of the business expects that they will not be paid. Maybe if you have been doing business for a number of years, you expect that some of the debts you will not be able to correct all the money you are expecting from your customers. And maybe from the past experience, you know, at least 10% of the money you are expecting to receive from your customers will never be paid, 10% of that amount. So it basically means that when the year is coming to an end, you may be expecting an amount of, for example, 1 million from your customers. So mean that the trade receivables, the money you're expecting to receive from your customers is 1 million. But basically, we are saying from the past experience, you know that 10% of the amount you are expecting to receive from your customers, that amount is never paid. That amount is never what? Is never paid. So therefore, what you need to do at the end of the year is basically to create something called the allowance or basically provision for doubtful debt. So what do you mean by allowance? What do you mean by allowance or provision for doubtful debt? Now, this is basically an amount of money which is set aside, an amount of money which is set aside to cater for the losses which will be incurred by the business in the future once the customers fails to clear their debt. Once the customers fails to clear their debt. Now, this provision or this allowance or this particular amount is set aside by the business in accordance with a certain accounting concept, which is known as the prudence concept. The prudence concept. So prudence concept is basically an accounting concept or is an accounting principle which is used in the preparation of the financial statement. And this concept states that if you are the owner of the business, or basically you are an accountant, and you are preparing the financial statement at the end of the year, in this case, you may expect to incur some losses in the future. A good example whereby you may be expecting to incur some losses after the end of the year is whereby you expect that some of your debtors will not pay. Like in this case, we are saying, if you have been in business, you may basically know that 10% of the money you are expecting from your customers is never paid. So it automatically means that if at the end of the year you are expecting 1 million from your customers, automatically 10% of this will not be paid. You will not be able to collect 100,000. Now, this concept, the prudence concept, then requires that whenever you are preparing the financial statement, you need to set aside 10% of your debtors, or basically your trade receivables, which is now 100,000. You set aside this money you are setting aside from your profit, basically to cater for the loss you are going to incur in the future once your customers fails to pay. And I've said that this money is set aside, this allowance is set aside from the company's profit in accordance with which concept? The prudence concept. The prudence what? Concept. Now, how do we account for this amount which has been set aside? This one is basically accounted for as an expense. But basically, we know that expenses are the costs which have been incurred by the business. But is this an actual expense? No. By accounting for this as an expense, you are treating it as an expense. What you are doing, you are purely setting aside 100,000 from the incomes or from your profit to cater for the loss we are going to incur in the future once your customers fails to do what? To pay. So therefore, once a provision or allowance for doubtful debt has been accounted for or has been created, it is then recognized as an expense. It is recognized as an expense. And therefore, the double entry for this is that we account for it by doing what? By debiting the income statement. Remember, we say the income statement is debited with all expenses, and then we credit an account called the provision or allowance for doubtful debts. Doubtful what? Debts. So assuming this provision or allowance for doubtful debt was created in year one, so you account for that amount as an expense. But now, when you go to year two, you will also create a provision based on the debtors' balances, based on the amount of money you're expecting to receive from your customers. So now, in subsequent year, that is in year two, what we account for here is the increase, or basically the decrease. That is what we account for in year two. Assuming in year two, or assuming in year one, the provision which was created was 100,000, but in year two, the company maybe was expecting to receive 1.5 million from the customers, 1.5 million, and the company need to create a provision of 10%. So meaning that the provision to be created in year two is 150. Do we account for 150 in year two? No, because in year one, we have already set aside 100,000. In year two, we account for the increase. So the provision you can see here is increasing with 1, is increasing with 50. So an increase in provision for doubtful debt, this one is accounted for as an expense. This is basically what you need to know, that this an increase will be accounted for as an expense. We debit the income statement, we credit this account, which is called the provision for doubtful debt account. For doubtful debt account, that is the increase. Always the increase in doubtful debt is accounted for as what? As an expense. But if it was a decrease, for example, the provision in year 1 was 100, but in year 2, maybe it reduces to 80,000. So in year 2, what we account for is not 80, but we account for the decrease of 20. So that decrease of 20 is basically accounted for as an income. So being an income, the double entry, we just reverse this. So we debit the account called the provision for doubtful debt, and then we credit the income statement. The income statement is credited with all incomes. Is credited with all what? With all incomes. Is credited with all what? With all incomes. With all what? Income. So therefore, this now what is important for you to note that once a provision has been created, we account for it as an expense. We debit the income statement we created. We credit the provision for doubtful debt. And then in the subsequent, in the following year, what we account for is the increase or decrease. So if it is an increase, it is an expense. If it is a decrease, it is what? An income. It is what? An income. It is an income. So that's basically what you need to know as far as the provision for doubtful debt is what? Is concerned. So therefore, all this particular knowledge which you have discussed here, all these particular concepts you have discussed in today's class is very, very important. You'll be able to see how we apply all these particular concepts, depreciation, how we account for accrued prepaid expenses, how we account for this particular allowance provision or the allowance for doubtful debt. This one will mostly be applicable in our subsequent what? In our subsequent topics. That's yes. So therefore, even before we meet now in our next class, where we will be looking on now how we prepare the financial statements of a sole trader, this information is very, very important. This knowledge is very, very what? Important. Yes. So I hope you have understood what we have learned today. Is there any question on what you have discussed today?